This segment is brought to you by Audit Shield, the service that protects CPA firms when the CRA comes calling, ensuring every hour you spend responding to audits or reviews is fully covered.
Welcome to our AJAG PD Pod, the place for discussion, debate, and learning about all things accounting. Our hosts, Ivan Tabak, Jonathan Tucker, are CPAs that have been in practice for more than 3 decades. Together, they bring varying experience and viewpoints to the table, not to mention a little humor, too. Join us as we talk through current issues and hot topics, tap into expert guest insights, and enjoy the odd walk down AJAG memory lane. Before we begin today's podcast, please note, although the educational material within the podcast has been carefully prepared, none of the persons involved in the preparation of the material accepts any legal responsibility for its contents or for any consequences arising from its use. As well, the podcast material and the references contained therein may reflect laws and practices that are subject to change. Advice regarding a particular fact or situation should always be reviewed by a qualified professional. This podcast is produced and distributed by AJAG Professional Development. For more information about AJAG or any of its offerings, please visit ajag.ca.
Welcome, everyone, to the AJAG PD Podcast, Season 2, Episode 10. My name's Jonathan Tucker, and today we're diving into the subject of intergenerational business transfers. My guest is Nathan Choran. Nathan is the lead for the Canadian tax group at Zeifmans. Nathan, welcome.
Thank you very much, Jonathan.
We've worked together.
We've known each other a long time.
We have. Anyway, I've been really looking forward to this. So
great.
But we want to talk about intergenerational transactions and transfers of businesses. And so why is that important nowadays?
Well, it's always important. There's always, parents who want to give up being involved in their business and looking to potentially passing on that business to the next generation. And, aside from the challenges from, personality, business, whatever, but there are obviously a lot of tax issues involved in doing so. And so that's essentially the topic I'd be discussing today.
But it's changed a little bit since 2024.
Yes.
So before and after, let's talk about that.
Yeah. So the issue before was that, typically in the Canadian context, when a company accumulates money and wants to buy, say, another business, often you don't want to necessarily put it in the same company that's been operational. If you were to distribute the money to the owner by way of a dividend, you're going to lose, say, 40 to 48% for Ontario resident in taxes, assuming the owner's at the top marginal rate.
Yeah.
So instead of, let's say, if you were doing a deal for a couple $1 million, if you were to pass a dividend to the owner, now you only have $1 million left. So obviously not very tax advantageous. So typically what you do is you form a Canadian holding company to take ownership of the operating company shares, and you could either dividend the money to that holding company or make a loan. And from a Canadian tax standpoint, typically that dividend is tax-free. So now instead of having, just in my example, only $1 million left to make the acquisition, you have $2 million left. So obviously it's a much more tax-efficient structure. So now the problem from a succession planning point of view is this. So now we're talking about a share transaction, not an asset transaction. And so the vendor would then want to naturally sell the shares of the company they own to the holding company that was formed by the purchaser. And if they're at arm's length, there's no issue. There would be a capital gain resulting. And if the person selling is an individual, they would be able to take advantage of a capital gains deduction. Now, just to elaborate on those concepts. So first of all, capital gains is much more tax efficient or tax effective than dividends, because a capital gain is only 50% taxable. So typically you're paying significantly less tax if you sell and you realize a capital gain. So that's one tax advantage. But the other tax advantage is in regards to capital gains deduction. So there are a lot of rules, but essentially if an individual sells shares that they term qualified small business shares, and it qualifies,
Or
then
farm or
it also extends to farming and fishing property, but
Yeah.
the more
lion's share.
typical one is qualified small business shares.
Yeah.
Then you could realize presently $1.25 million of that capital gains essentially tax-free.
Yeah.
So obviously a very strong incentive to want to sell, get a capital gain, and hopefully if you've structured your affairs properly, 1.25 million of that capital gain deduction is tax-free. Now, if you have several owners, that's, the capital gain deduction could be multiplied many times over. So even more of a strong incentive to do it. So that's an arm's length situation. Now, the problem with succession planning, though, is that if, let's say, a father was to sell or mother to sell their shares of their business to a holding company that was formed by their children, instead of getting a capital gain, there's a rule in the Income Tax Act, Section 84.1, that says, no, you don't get a capital gain, you get a dividend. And it converts the capital gain to a dividend. And that's problematic because obviously, as I mentioned, a dividend is taxed at a much higher rate of tax.
You're back into that original scenario.
Exactly.
Yeah.
And if you don't get a capital gain, you can't get a capital gain deduction. So typically with succession planning, there has been historically more of an incentive, ironically, for a parent to sell their business to a stranger than it is to their own, next of kin. Yeah. So that's obviously been a major sore point, and it's remarkable, like the capital gain deduction has been around since 1985. It's remarkable that these rule changes really only came about more recently, and so 40 years later, although the government's hand was forced because of a private member's bill that kind of made it a bit of a free-for-all for a 3-year period.
So I guess somebody watching this today might ask the question, so why was 84.1 in there in the first place?
Right. So, just like many rules in the Income Tax Act, it may present difficulties in one area, but there is logic to it. So, we're talking about in the context of a succession plan. And so the difficulties presented by 84.1 in succession planning. But let's say you have a situation where a company has $1.25 million in it, and the owner just wants to take that money out and is looking for the most tax efficient way to do it. Okay, so what, as I mentioned, if he took the money out or she took the money out as a dividend, that's a problem. You're losing, probably 40 to 50% in taxes. Not good. So instead you say, oh, you know what? This is what I'm going to do. I'm going to, effectively form a holding company, and I'll sell all or some of my shares to that holding company. I'll trigger a capital gain. Now the shares of the operating company is owned by the holding company. The operating company could make a loan to the to the holding company or pay a dividend. Again, as I mentioned, likely it's going to be tax-free. And now, the holding company is indebted to the owner for say $1.25 million in my example. And now I got to take the money out for $1.25 million without paying any tax. So here's a situation. It's exactly a surplus strip type transaction. So, the government realized that, hey, we don't want this. It's one thing when there's an actual sale going on and
a real sale between
true sale and stuff parties, but we're not going to let you use your capital gains deduction on just like run of the mill, way of taking money out of a company and paying no tax as opposed to paying tax on a dividend. So hence there is some logic to it, but obviously,
and then by converting it into dividend, you're getting into integration. Right. And that I think probably was a higher priority in terms of preserving integration than it was dealing with these other issues.
Exactly. But at the end of the day, when it's all said and done, if you're getting a capital gain, that never mind paying tax. Okay, here you're getting the ability to claim the capital gain deduction, paying no tax. You can see how the government has a bit of a problem with that.
Well, you can also see how the second generation trying to buy out is facing a financial problem.
100%.
All right, that's
100%. So that's the imminent unfairness of these rules, is that yes, there is logic to it, but because they didn't try to curb to those kinds of situations and extend it to succession planning, and the fact that you're incentivized to sell to a stranger than to your own family is a bit kind of ridiculous.
So for those watching today who might not have a lot of transactions like this, before the changes in 2024 came in, how was succession planning? What was the typical arrangements to work around this?
Yeah.
Walk us through those.
So typically what would happen is what you would implement what was commonly termed an estate freeze. Now, the transaction itself, okay, yes, the term estate freeze is, one thinks of in terms of estate planning where I'm effectively trying to minimize the value of my company's shares.
You want to freeze the value?
You want to freeze the value so that when you pass away, you are effectively capping the value and therefore the tax that's going to arise on your death. But effectively, the transaction for the purposes of succession planning is one and the same. So what effectively is happening is that the parent, who's the common shareholder, is going to exchange their common shares for a class of preferred shares. Those preferred shares are not future growing shares. They're capped in value.
Redeemable for $1 or some
amount. For redeemable for the fair value,
yes.
What the value of the company was at that time.
Yeah, I meant that more that you'd issue the number of shares equivalent to.
Yes, exactly. There's several ways you can do this, but typically the most common ways you see is that the parent exchanges their common shares for a class of preferred shares. The value of the preferred shares is equal to the value of the common shares at that time. And now effectively it enables the children to subscribe for new common shares of that company at a nominal cost.
And then the growth passes on to the next.
And the growth cost. So effectively it's a very effective way to at least introduce the next generation in the sense that they don't have to cough up a lot of money to become the new shareholder. Any future growth will accrue to them, so that's good. The other thing is, as we'll see in the context of these new rules, is that there's really no restrictions on them. There's no rules governing how you have to conduct your business and stuff, unlike the new rules that I'm going to describe, which has many of them. So it was very flexible and, nonetheless, it accomplishes a good objective. But the problem is that it doesn't put any money into the pockets, into the genes of the parents.
They're still in the same position.
They're still in the same position. Yes, you've enabled
the next shares. They're still dealing with a dividend.
Correct. If you redeem the shares, you get a dividend. You don't get the capital gain that you want, and particularly you won't get the capital gain deduction. So, great, you've accomplished some objective by this estate freeze to introduce the kids for the next generation, but you certainly have not given any kind of cashing out to the parents on a tax efficient basis.
So there's still this bias again towards sell to an arm's length party rather than to in that scenario.
Correct. Exactly. So
just walk us through for a minute where there's an estate freeze that's brought into play.
Yes.
It's based on a valuation, but then the next generation, the business doesn't continue to grow. What's the planning where the value of the business actually decreases?
Oh, well, there's something called a refreeze transaction where the parent is allowed to essentially exchange their frozen preferred shares for a new class of frozen preferred shares at that lower valuation. So, yes, there is some protection in the event that, it's underwater, the value of the business and stuff like that, that you're not paying tax at death on that higher valuation once upon a time.
And that's the point here that really is necessary, because otherwise you're stuck with shares at a fixed value if you don't trigger that refreeze.
Well, arguably, you still could say that at death, I've valued it based on what the value is, and that's all I paid tax on. But often, if you do come across that situation, the parents may say, "Look, I still have more than enough wealth. Just to save on death taxes, I'm going to refreeze just so I can now lock in a lower valuation if the business grows in value going forward in the future, and at least now the children get that delta also."
Right.
So you're formalizing that through another transaction.
Jason, good to see you.
Great to be here, Jonathan.
So from what you've seen at Audit Shield, how is the CRA's use of AI affecting things?
Well, the usage of AI tools at the CRA are making reviews a lot smarter and certainly more frequent, especially as compared to about a year previous. And they're using their AI-driven data analytics to flag your discrepancies, very simple, unusual patterns, and your high-risk filings, and they're doing this all at scale. What's interesting, of course, is that the tools can cross-check thousands of data points in seconds. So even the smallest anomaly is being flagged, whereas in years previous, it may not have even been noticed.
Yeah. And so what's that mean for CPA firms?
Well, simply put, more of your clients are being flagged, even those that have so-called clean records. You could say that the reviews are often more detailed, requiring more extensive supporting documentation. And of course, it's your time. We're certainly seeing an increase in the amount of time spent in having to respond by the CPA to the CRA.
Right. So where's Audit Shield fit in?
Well, simply put, we're your safety net, right? Because we make sure that 100% of your time responding to these disruptions and CRA scrutiny is covered by us. So 100% of your professional fees are covered by Audit Shield.
Yeah, that's important. Jason, how do people get in touch with you?
Well, there's a URL on the screen, and certainly my email address is jason@accountancyinsurance.ca.
Great. Thanks so much, Jason. So then 2024 comes along. We're moving from a problem to a solution.
Yes.
So let's walk through the solution now.
Okay.
This is really where the change
Precisely.
people may not be aware of, right?
Precisely. So these are, relatively new rules. And so the government recognized, and I said their hand was forced to make changes to the law. So they said, okay, look, we're going to overhaul Section 84.1 to give the benefits of the capital gain and the ability to claim the capital gain deduction in a non-arm's length context. But we want to ensure that this is happening in the context of a true business succession.
People aren't playing games, just saying it.
Precisely.
Right.
If it's not going to be a true business succession, and we'll go into defining what that is in their eyes, but then no, the rules still apply. And if you do a non-arm's length sale shares from a parent to a holding company of a child, you're going to get that deemed dividend that is not going to be very tax effective. So they've brought about a lot of rules and stuff like that. So essentially what they're doing is they're saying, okay, there's going to be certain conditions that have to be met at the time of the actual sale from the parent to the holding company owned by the children. And I should mention at this time that one of the nice things they have done as part of these business succession rules is that they haven't limited it to just your next of kin. You could sell to your grandchildren. You could sell to a niece or nephew.
Which is broader than it was before.
For sure. For sure.
Okay.
And you could sell even to the children of your niece and nephew. And that still also will qualify. It won't apply between cousins, but it will apply between, either, children, grandchildren, or the children of your siblings and stuff like that. Siblings, no, because that's perceived as the same generation. They're looking at the transition to the next generation. So, they've devised rules that will come into play at the time of the sale, and then what they want to see in the transitional period. And they have two regimes. One is what they call the 3-year, immediate transition, and then there's the 10-year gradual transition.
So what's the thinking behind this, Nathan? Why are they saying they're introducing a period of time following? Is this to make sure it's really what it?
Well, they want to, the criteria they're looking at to ensure that there is a true business succession is the following criteria. They're looking at, one, that there's going to be voting control going from the present generation to the next generation. That's one thing. They also want to see that the economic interest of the parent is going to be eliminated or certainly substantially reduced. And then the third thing they want to see is that the children, or at least one child, is active in the managing the business, and that the parent is going to step back from managing the business. So those are the four main criteria they want to see to say that, okay, this is a true business succession scenario, and therefore we don't want to deprive a parent of realizing a capital gain from selling their shares to the holding company of the child and, the capital gain deduction. I should mention also, just in case it's not clear, but a capital gain deduction is really a cumulative lifetime amount. And so it only pertains to an individual up to $1.25 million of gains, right? And it does get indexed annually and stuff, but still there is a certain limit to it. But a capital gain, that could be unlimited. So if I sell shares worth $10 million to my, the holding company of my child, I get a $10 million capital gain instead of the $10 million dividend. Sure, only maybe 1.25 million is going to be tax-free, but there's still a substantial tax saving by realizing a capital gain rather than a dividend.
Yeah, absolutely.
Okay.
And just an aside, in the examples you're giving, you keep talking about parents selling to a holding company of the kids.
Yes.
Any particular reason it has to be a holding company?
Well, yes. Well, I mean, again, but the idea is that the child wants to set up a company because then after the sale, right, they can maybe strip out some of the money that's in the operating company through an intercorporate dividend or possibly a loan and use that money. So instead of coming up with their own personal funds or taking money out of that company, which means paying personal tax, instead you're using the existing surplus in the opco to effectively pay off the parent.
Okay, fair enough.
Yeah. So, there's those are the main things. Now, the criteria that has to be met at the time of the sale, at least, is that we're talking about the vendor being an individual, that the shares are qualified small business shares. Won't get into the criteria. There are several of that. There is a purchaser corporation involved, and again that the owners of the corporation are the next of generation. As I mentioned, could be children, grandchildren, niece, nephew, the children of the niece or nephew, any combination of them, or just one alone, etc. And but they have voting control of that purchaser corporation. Okay.
Yeah.
So, and then one other interesting rule change that they made as well, before we get into discussing about the, the 3-year regime and the 10-year regime, is that typically speaking, when you sell shares, or even it could be any property, and let's say not all of the money is due at once. So you try to say, okay, I'm going to pay you a certain amount now, and I'll pay further funds later. You're allowed to take, for income tax purposes, what's called a capital gain reserve.
Right.
And so typically the maximum period for claiming a capital gain reserve is 5 years. Minimum 20% per annum that you're required to bring into income, but effectively it's good for a 5-year period. In the context of these rules now, they've introduced a 10-year capital gain reserve period. So again, if you're within the realm of these intergenerational business transfer rules, you could have the parent sell to the holding company of the child, and you don't have to structure that, you're getting all the capital gain all at once because you may not have the money there. So you could, structure it that, hey, I'm going to pay you off over a 10-year period, and they're only bringing in 1/10 of the capital gain into income annually. So very, very
so 10% instead of 20% with the existing 5-year capital gain reserve.
Right.
This
precisely
10%.
10% per annum.
Over 10.
Exactly. And, I mean, if you get the capital gain deduction, conceivably, you may not pay tax in the first few years, early years, and you're only talking about paying tax in the latter years. You don't have to prorate the capital gain deduction. You could, front load that. So, which makes sense.
Now, is that, because we're going to talk about the 10-year regime, but is the 3-year regime, does that qualify for the 10-year period of time to recognize the capital gain?
So here's the thing. There's some commonalities between the two regimes, and then there's some differences, as one would expect. So the commonality, so I mentioned to you there's 4 broad categories that you need to meet in order to be a true business succession in the eyes of the Department of Finance. The first I mentioned is the area of voting control. So there's no difference between the 3-year and the 10-year regime in that regard. From the point of view of voting control, immediately the parent cannot have voting control over the purchaser corporation or of the operating corporation. So that's one thing that
they can still be involved, but they can't be.
They could still be a voting shareholder, but not the majority voting shareholder. So you're immediately ceding voting control over the company. Now, annoyingly, one difference is that in the 3-year regime, you also, besides what they call de jure control, the actual factual, they also extended it to de facto control. I really don't understand why that doesn't appear in the 10-year regime. De facto control means that the degree of influence exercised by the parents is akin to as if they had actual voting control. The reason to me it's annoying is because, as I mentioned to you, you may structure the sale to be over a 10-year period. And so the question becomes, well, if the company's indebted to you for a significant amount of money, does that constitute undue influence, that could constitute de facto control? The CRA seems to suggest, no, we're not going to do that, but I never like, relying on CRA comments and stuff like that. So, but at any rate, that's one innocuous difference between the two, but nonetheless, the similarity: immediately, no voting control. And then at the end of 3 years, you actually cannot have any votes in the company at all. Mm-mm. So you have total elimination of any kind of voting rights in respect of the purchaser corporation and operating corporation.
So no voting rights.
No voting.
So how do you, as a practical matter, execute that? Because if you've
in my mind, the answer is that the parent better be very prepared to walk away. So in other words, if they have a personality that, a control freak, probably these rules are not going to be very good for them. And which
they built the business, right?
Yeah, well, I know, but that's one thing.
Yeah. And
the other thing is, obviously you have to be in a very significant position of trust vis-a-vis your children, naturally, because as I mentioned to you, they're not just giving these beneficial entitlements to the capital gain deduction without certain restrictions being imposed on them. They want to ensure that this is a true business succession. Yeah. So that's where they basically say, nope, the voting control, you're going to have to be completely out of the picture by the end of 3 years. 3 years. Right. And not having any kind of completely, and not having voting control immediately.
Right.
Okay. Right. So that's one similarity between the two rules.
Right.
Whether it be a 3-year regime or 10-year regime.
Right. Right.
The other similarity between the two is that your economic interest in the company. So again, under the 3-year and the 10-year regime, basically, again, you are effectively ensuring that by the end of 3 years, you're not going to have any common shares at all. You can only have what they call a specified class of shares, which are preferred shares, non-voting, and also there's a certain restrictions on dividend entitlements and so on. But effectively, by the end of the 3-year period, under either regime, you basically now have to go to effectively just owning preferred shares. Right. Okay. Right. Now, there is one additional restriction imposed on the 10-year regime, which is that by the end of the 10th year or sooner, your economic interest cannot be more than 30% of what you had originally. Oh. So,
minority.
They want to ensure that your interest in the company is not like just lingering there till the day you die, that you're really making the company have to pay you off. So the what they allow up to 30%, but no more. Right. Okay. Right. In the case of the 3-year, technically you could have it much longer than that. There's no rule imposed there.
So what do you think of these changes? Looking at the two scenarios, arm's length versus non-arm's length, have they achieved what they were hoping to achieve?
Well, that the jury's out. I do think that it's a good start. I think maybe rules will get tweaked over time, to see. I'm sure the government will want to see what the take-up is going to be of this and so on. And then they may tweak the rules, but, maybe become a little more lenient. By the way, we haven't gone through all the restrictions yet. So it's going to be a little more than that. But I do think that these rules are probably more geared towards small businesses and probably medium, but on the lower end of medium, as opposed to large, medium, and large companies, just because of the difficulties, particularly large business. You're talking about larger amounts. Probably they're doing business in many places, in many countries. Probably not so easy to achieve as a small business is.
Yeah, interesting.
Okay.
All right. So then have we covered the details in both the 3 and the 10?
So I described the similarities. Yes. Now here's where the difference is lie, and that's where it's really in regards to the management of the business. So again, as I mentioned to you, another criteria they want to see is that the child is actively involved in the business. In the 3-year regime, they want to see that you've been actively involved for that 3-year period. Yeah. And in the case of the 10-year regime, they want it so when I say the 3-year period, meaning from the date of the share sale until the end of 3 years following. Yeah. In the case of the 10-year regime, they want to see it from the day the share sale was arrived at until it's either, I think it's later of or the earlier of when the final sale time arrives, and 60 months. So
I remember 60 months.
Yeah. But they want to see that the child is actively involved in the affairs of the business. Yeah. And then the other end of it is that the parents now are walking away from the management of the business.
Right.
And so once again, they basically say here that the parents in the 3-year regime, it's whatever time is reasonable under the circumstances, but the safe harbor rule is 36 months. So if you want to be absolutely sure of meeting the criteria, you have to basically be not involved, the parent, in the management of the business at the end of 3 years. In the case of the 10-year regime, the safe harbor is 60 months. So if you want to be absolutely sure that there's no risk of the rules not being satisfied, better that they should leave the management of the business by the end of the 5th year. Now, one question somebody asked me is, how will the CRA know? I mean, it's a good question. I mean, I should hope it's not Big Brother. They're not setting up cameras all over your business to see the degree of involvement. But, I think there is some element of,
Well, I'm sure
you don't have to do it.
They could always interview staff or things like that.
They could do that, stuff like that. But, one of the questions that was asked about, like, can you be a director of the company, for instance? The CRA's comments is, no, a director is involved in overseeing the affairs of the company, can't be a director. Somebody asked the question, can they co-sign checks?
I was going to say signing officer.
So, well, they said, no, but that too,
Really?
you have to,
even signing officer.
Even as a signing checks, that could constitute being involved in the business. Now, what they do say in the legislation is that you can be a consultant to the business.
Okay.
That qualifies. That's okay. That's not considered managing the business. So if you're a
I guess they're trying to make it as akin to an arm's length transaction as possible.
Precisely. I mean, I also had a situation where a parent owns a pharmacy, wants to pass it on to their child who's also a pharmacist. I mean, in my mind, there's nothing that restricts the parent from continuing to be a pharmacist in the pharmacy. That's not managing the business. You're just helping out, and dispensing drugs to me does not constitute managing a business. But, so I don't think it necessarily precludes them being an employee of the business either. But certainly if you're just an independent contractor consultant, that for sure, entrenched in the law, it says that you're not considered to be managing the business. So those are the distinctions between the 3-year regime and the 10-year regime. So I guess the question then begs is, so how will the government know which regime you're falling under, right? So the answer to that is that when you do the share sale, the law requires that there's a joint election filed between parent and child. And so because they recognize the fact that it's not only up to the parent to satisfy conditions, it's also up to the child in particular that they're going to be actively involved in the affairs of the business, right? Actively involved in, running the business and stuff like that. So you can't just so they recognize that, hey, the parent, if we don't file this joint election, the parent could say, oh, look, it's not my fault. I mean, my child didn't live up to his commitments, he shouldn't penalize me. So it was
both parties are on the hook.
Precisely. This election makes not only the parent liable for any additional taxes that will arise by not satisfying the requirements of the intergenerational business transfer rules. They're also going to make the child jointly and severally liable for those taxes.
So if they didn't meet that criteria, then it would revert back to the 84.1 scenario,
which is a dividend, and the taxes could be horrendous. Plus interest. Exactly. And so on. So I don't think there will be penalties because presumably you're doing it in good faith. But nonetheless, it would be that. Now, I mean, in fairness, you could say, well, that's crazy. Like, what happens if something happens to my child? They get into an accident. Then okay. So they do have rules that basically allow for certain life events that, precludes, the inability of a child, let's say, to be involved in that. So it contemplates one, if a child has death or disability, they will only apply the rules up to that point in time. They also talk about an exit event. So, they don't want to necessarily stop you from being able to satisfy, to be able to sell the business. But again, so on an exit event, they will only apply the rules at that point in time. Naturally, the longer the child operates a business, the more growth goes in their hands. So, if you thought, oh, great, I'll do this, and, the child is only going to operate the business for a short period of time. Okay, well, maybe you've achieved your objective of passing on, but they didn't really get the benefit from it very much. And if you were going to sell to an arm's length person, then why bother? You might as well just sell directly to that arm's length person anyways. So that's not really a loophole, I would say. They just recognize that if there's an exit event, we were going to apply the rules at that point in time, not hold you to like a 3-year or 10-year period.
Right.
And then finally, if there's an insolvency of the company and it's can't function anymore because of certain events, then, again, they will only apply the rules up to that point at the time as well.
Okay.
Yeah. So those are things. So, and the only other thing I should mention is you could say, well, hey, normally speaking, you can only reassess the CRA within a 3-year period from the date that they assess the tax return.
Right.
10 years, like they can't do anything to me at that point. It's way too late.
You would think, right?
Right. Except, so they think of these things. I must say, they're not dummies at the Department of Finance. So they think of these things and they said, okay, well, you know what, because we recognize the fact that it's just going to take a lot longer than 3 years for us to know when, if these rules are satisfied. So they extended the statute barring period from, if you're relying on the 3-year regime, from 3 years to 6 years, and in the 10-year regime from 3 years to 13 years.
Right.
So therefore they still have that window of time to reassess for the dividend and stuff like that.
Question for you. Is that statute of limitation only on that transaction, or does it keep the...
No, just the transaction.
It is,
just the transaction. We're not applying it for all purposes of the Income Tax Act.
15 years is...
That would be crazy. No, it's only on that.
Yeah.
But by the way, so when you file this joint election, you do have to, there's an actual prescribed form.
Yeah.
If I remember correct, it's form T2066. And you have to actually indicate which regime you're going to fall under.
3 or 10
3 or 10 years. Yeah. So you're marking off. Now, that said, I don't think the law precludes that, if I'm not going to be able to satisfy the 3-year, that
can you change
to the 10-year? I think you could do that.
Okay.
Notwithstanding that you may have marked off in the joint election and stuff like that, but it depends on what criteria hasn't been met. If the child's not actively involved in 3 years, they're not going to be actively involved in the 10-year period.
And when's that joint election filed?
It's filed by the due date for the tax return that includes the sale of the shares for the parents. So, so if they, normally speaking, most people have to file by April 30th. So if the sale happened in 2025, you're filing an election by April 30th, 2026.
Okay. Yeah. All right. Any other details in common with these regimes, or have we covered them?
Well, as I mentioned, there has been some interesting questions asked to the CRA. I talked about the fact that, they've been asked about whether you could be a director or assign the checks. One question I thought was interesting was, does the parent have to sell common shares? So what if they had already undertaken an estate freeze before, right? The answer is no. The rules don't preclude. They could sell frozen preferred shares as long as they are, voting. They have voting, control of the company and stuff like that.
Which they would in an estate freeze.
Typically, you still usually ensure that the parents'
their interests are protected with votes.
Precisely. Yeah. So it's still, as long as the kind of the background to doing a business succession is still there, even though the parents had already undertaken the estate freeze, nonetheless they do not say that, hey, you're precluded from selling frozen preferred shares as opposed to common shares.
That wouldn't be an issue. Why would somebody...
Well, because again, you want to take advantage of capital gains.
Oh, I know, but why would there be a distinction made between preference shares versus common shares?
Well, somebody's just asking a question that says, is that equally applicable? Yeah. The law doesn't say you can't. Yeah. Somebody just wanted to have the certainty of knowing whether you could do that for frozen preferred shares as you would for common shares. Okay. So and so they gave a favorable opinion on that. The only other things I should mention is that these rules are only supposed to apply once per company. So if, let's say, parent owns 2 separate corporations, each conduct separate active businesses, and they want to do the intergenerational transfer with one of the companies. So they can only take advantage of these rules once as it relates to that corporation. But that doesn't preclude taking advantage of rules in regard to the shares of the second corporation.
So sometimes I've run across where parents will have set up a couple of corporations, divisions. Yeah. And so what you're saying here is because they've got different kids and they intend the kids to continue on. So as long as they're separate entities, then they could still...
Or they're ready to transition for one business, but not necessarily both. Yeah. So they could, stagger doing that, that kind of planning. The only other thing is that, there can only be one because you can only do it once. So let's say you have 2 children you want to transition to. You don't have to necessarily have them have their joint purchaser company. They can each form their own. But you have to do the share sale simultaneously.
I see.
As it relates to it, so you can't stagger that.
Restrictive, eh?
A bit, but again, as long as at least one of them is actively involved in the business, and at least that one of them will be able to manage the business at the end of that transitional period, then you're still okay.
Again, I'm thinking of the scenario in this case with this client where one child's 21 years old and the other's 33 years old, right? So very different stages of life. And do you want to put those two and they don't get along? So that just adds another level of complexity, and that's part of the reason for the structure so how
precisely I obviously there's routine type transaction, and then there's going to be non-routine type transactions, and it may not be one size fits all here. You may have one that's going to be a sale, and then in another case you're going to do an estate freeze with the rest and stuff like that. You know what I mean?
You're still going to want to add a minimum, even if you've used up that lifetime capital gain exemption. You're still going to want to try to get into that scenario rather than the original 84.1 type structure.
But again, if you're not going to do that, then maybe it's some estate freezing might be the answer again. It depends again. The various rules and how fitting everything together. It may not be possible. Maybe you just can only do the estate freeze. So it's on the one hand the government gives, and on the other hand they kind of take away, because they do impose a lot of restrictions, not so easy to fit into it. And that's why I say I think effectively you're looking for a client that essentially the parent really is committed to walking away from the business. They fully trust their children, and I said, typically, I would think that a small business is better suited to this than a larger business. I mean, certainly, if you have a very large business, the capital gain deduction, the benefit of that diminishes considerably. You know what I mean? So, so for that reason, I think it's.
Are there any other comments from Department of Finance or CRA that are of interest in terms of this thing?
Well, those are the 3 that I chose. About the purchaser corporation, about being a director, co-signing, and I figured I'm not going to go on ad nauseum about the different CRA interpretations.
Absolutely. Okay. So, any concluding comments on this?
Well, I mean, obviously the rules are complicated, and so you need to. I highly recommend that you consult with a professional advisor that is very familiar with these tax laws. These are recent laws, so I would think that there are many accountants that aren't familiar with the rules, but nonetheless, you have to seek professional advice, and probably will entail also having discussions with the next of kin, which is a good thing, and so going through it and seeing if it can be, if you can avail yourselves of these rules.
And so for those watching today, if you are in that scenario and you want to connect with Nathan, his contact information is on screen, so feel free. They should reach out to you.
Sure.
I've done that over the years, so always grateful for your advice. Nathan, thanks so much for coming in and walking us through these new rules. It's been an interesting topic. Well, thanks everyone for joining us on today's episode of the AJAG PD Pod. We hope this was an insightful and interesting topic, and that you found it to be helpful. Please remember to like and subscribe and share with anyone that might find this information useful. They'll definitely thank you for it. Until next time, I'm Jonathan Tucker. We look forward to seeing you in future podcasts. Take care, everyone.